Good day, everyone. Today's session focuses on transfer pricing and corporate governance. Corporate governance and transfer pricing. This will be discussed under Module 17. Transfer pricing is the pricing of goods, services, and intangibles exchanged between related entities within a multinational group. Now, given the complexity of transfer pricing and its significant implications for tax compliance, corporate governance plays a crucial role in ensuring that organizations manage their transfer pricing practices effectively. So, we will explore the role of corporate governance in transfer pricing, how it can enhance compliance and risk management, and best practices for aligning governance structures with transfer pricing policies. To bring these concepts to life, we will review several case studies illustrating how companies have successfully integrated corporate governance into transfer pricing frameworks. So let's get started. Overview now. The role of corporate governance in transfer pricing. So, corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It ensures that the interests of stakeholders, including shareholders, employees, customers, and tax authorities, are protected. Effective governance enhances accountability, transparency, and compliance. In the context of transfer pricing, corporate governance ensures that transfer pricing policies align with legal and ethical standards while protecting the organization from tax risk. So let's look at the key roles. The key roles of corporate governance in transfer pricing: oversight and accountability. Under this oversight, we have board of directors and we have the audit committee. So let's start with the board of directors. The board is responsible for ensuring that the company's transfer pricing policies are compliant with regulatory requirements and meet ethical standards. This involves overseeing management to ensure that risk related to transfer pricing are managed effectively. Now let's look at audit committee. The audit committee plays a critical role in monitoring the implementation and effectiveness of transfer pricing policies. It ensures that appropriate documentation is maintained and compliance with transfer pricing regulations is consistently met. The committee also works with internal and external auditors to verify that transfer pricing practices align with the company's risk management framework. Now let's look at policy development. Transfer pricing policy. A well-defined transfer pricing policy establishes clear guidelines and procedure for determining the arm's length prices of intercompany transactions. Now, the policy should be reviewed periodically to ensure it reflects any regulatory changes or business adjustments. Now, under this policy development, we also have documentation policy after the transfer pricing policy. Now, maintaining comprehensive and accurate documentation is critical to support transfer pricing decisions. The documentation must be aligned with OECD guidelines, BEPS-based erosion and profit shifting action plans, and local regulations, ensuring that the appropriate documents, e.g., master file, local file, and the country-by-country reports are prepared and updated on time is very essential for audit readiness. Thirdly, we have risk management. Under risk management, we have identification of assessment and mitigation strategy. Now, identification and assessment. Corporate governance systems are responsible for identifying potential transfer pricing risk, such as regulatory changes, economic fluctuations, or operational complexities. These risks are assessed to understand their potential impact on the organization and its compliance frameworks. Now, the mitigating strategies or mitigation strategies. Governance ensures that strategies are in place to mitigate transfer pricing risk. This could include conducting regular reviews of intercompany transactions, entering into advanced pricing agreements, or implementing internal controls to monitor and address any inconsistency in transfer pricing compliance. Now, with respect to stakeholder communication, let's talk about the transparency. Governance frameworks promote transparency by ensuring that transfer pricing policies and practices are communicated to all relevant stakeholders, including tax authorities, investors, and employees. So transparent practices build trust and ensure that stakeholders are aware of how the company manages its transfer pricing risk. Engagement. Engaging with stakeholders, particularly tax authorities, on transfer pricing issues is critical for managing risk. Proactive engagement can help resolve issues before they escalate into disputes and ensure alignment between the company's transfer pricing practices and its broader business objectives. So we will look at compliance and risk management through corporate governance. Corporate governance enhances compliance and risk management in transfer pricing by establishing a robust framework for monitoring, reviewing, and reporting transfer pricing practices. This framework ensures that the organization adheres to local and international regulations while effectively managing the risk associated with intercompany transactions. Now, regulatory compliance. Now, let's look at compliance. Regulatory adherence. Ensuring regulatory compliance, corporate governance ensures that transfer pricing policies comply with relevant local and international regulations, including OECD guidelines and the BEPS action plans. Compliance is monitored by the audit committee and is subject to regular review by internal audit teams. Regular updates. Governance frameworks ensures that the organization transfer pricing policies and practices are updated regularly to reflect changes in tax laws and regulations and even the international guidelines. So this ensures that the company remains compliant in an evolving regulatory environment. With respect to documentation, governance ensures that the organization maintains detailed and accurate documentation to support transfer pricing decisions. This includes conducting functional analysis, benchmarking studies, and maintaining financial data that justify the arm's length nature of intercompany transactions. Now, timely reporting is also another thing. Timely reporting, transfer pricing reports such as the master file, local file, and CBC must be prepared and submitted on time to meet regulatory deadlines. Timely reporting is critical for managing audit risk and ensuring compliance with local tax obligation. So, internal controls. Establishing internal controls. Strong governance system establish internal controls to monitor compliance with transfer pricing policies, and this control include regular internal audit, periodic reviews of transactions, and monitoring the effectiveness of transfer pricing practices. So it is very, very important to always conduct that. So enforcing policies too is also important. Corporate governance ensures that these internal controls are enforced and that deviation from established transfer pricing policies are identified and addressed promptly. So let's go to risk management. Under risk management, we have the risk identification and assessment. So let's start with identifying transfer pricing risk. Corporate governance frameworks are responsible for identifying transfer pricing risk. This risk could arise from regulatory changes, economic fluctuations, or operational complexities within the company structure. Now, assessing impacts. Once risks are identified, their potential impact on the organization is assessed. This allows for a proactive approach to risk management where risks are mitigated before they escalate into compliance failures or tax disputes. Now, number two, with respect to mitigation strategies. Developing mitigation strategies. Governance ensures that strategies are in place to mitigate transfer pricing risk. Common strategies include entering into advanced pricing agreements with tax authorities to lock in transfer pricing arrangements and conducting regular reviews of intercompany transactions to ensure compliance. Automated system is also very important. Implementing automated systems to monitor transfer pricing transactions and documentation helps mitigate risk. Automation reduces the likelihood of errors and ensures consistency in transfer pricing practices across the organization. Now, audit readiness. Now, corporate governance ensures that the organization is always prepared for potential tax audits. This includes maintaining comprehensive documentation, conducting regular internal audits, and reviewing intercompany transactions for compliance. Also, engaging with external auditors to manage complex transfer pricing issues. Governance frameworks ensure that external advisors, such as tax consultants or legal experts, are engaged when necessary. This ensures that the company is well prepared for any audit or disputes that might arise. So, best practices in corporate governance now is what we are looking at. Implementing best practices in corporate governance and transfer pricing helps organizations achieve compliance, manage risk, and enhance stakeholder confidence. By adhering to these practices, companies can ensure that their transfer pricing policies are aligned with regulatory requirements and business objectives. Now, best practices. One, you need to establish clear policies and procedures. Develop and implement clear transfer pricing policies that align with both regulatory requirements and the company's business goals. These policies should provide clear guidance on how arm's length pricing is determined for intercompany transactions. Make sure you document these policies in a comprehensive transfer pricing policy manual that is accessible to relevant teams across the organization. Two is strengthening oversight and accountability. Ensure that the board of directors and audit committee play active roles in overseeing transfer pricing practices. Their involvement is critical for ensuring accountability and managing risk. Assign responsibility for transfer pricing compliance to a dedicated team or individual within the organization. This helps streamline the management of transfer pricing policies and ensure that someone is accountable for compliance. Thirdly, enhance documentation and reporting. So, maintain detailed and accurate transfer pricing documentation to support decisions, including functional analysis, benchmarking studies, and financial data. This documentation is critical for audit readiness. Prepare and submit required transfer pricing reports, such as master file, local file, and CBCR reporting on time to ensure compliance with local regulations. Number 4 is to implement robust internal controls. There's a need to establish strong internal controls to monitor and enforce compliance with transfer pricing policies. This could include automated systems, regular audits, and cross-departmental reviews. Conduct regular internal audits to ensure adherence to transfer pricing policies and identify areas for improvement. Number 5, foster transparency and communication. Communicate transfer pricing policies and practices to key stakeholders, including tax authorities, investors, and employees. Transparency builds trust and reduces the likelihood of disputes. Engage with stakeholders to address concerns and ensure that transfer pricing practices are aligned with the company's broader business objectives and regulatory requirements. Number 6, it is also important to leverage technology and automation. Implement automated systems to monitor and manage transfer pricing transactions and documentation. Automation helps ensure accuracy and consistency in managing intercompany transactions. And use data analytics to identify potential transfer pricing risk and proactively address them. So we should go to case studies now. So let's review some real world examples of how companies have implemented these best practices that we have highlighted above. Now, enhancing oversight and accountability. So let's use XYZ Corporation, a multinational company, strengthening its corporate governance framework to enhance oversight and accountability in transfer pricing. Now, the implementation is that the board of directors establishes a transfer pricing committee to oversee transfer pricing practices and ensure compliance. You can see, take note of that transfer pricing is a very, very important issue. Establishing a board of directors, the board of directors establishes a transfer pricing committee to oversee transfer pricing practices. You can see the board of directors, establishing or form a committee to monitor transfer pricing issues. Now, the audit committee regularly reviews transfer pricing policies and documentation to ensure adherence to regulatory requirements. Now, XYZ assigns a dedicated transfer pricing team to manage compliance and documentation. Now, let's look at the result of all this implementation. You will see that the improved oversight leads to enhanced compliance and reduced risk of disputes with tax authorities. Regular communication with stakeholders enhances confidence in XYZ transfer pricing practices. Now we'll move to case study 2, strengthening documentation and reporting. In this particular case, we're using ABC Limited, a global manufacturing company, implements best practices in documentation and reporting to ensure transfer pricing compliance. Now let's look at how they implement this issue or this transfer pricing guideline. Now, ABC maintains detailed transfer pricing documentation, including functional analysis, benchmarking studies, and financial data. The company implements automated systems to monitor and manage transfer pricing transactions and documentation. Regular internal reviews and audits are conducted to ensure adherence to established policies and procedures. Outcome now, with this whole implementation of maintaining detailed transfer pricing documentation, including functional analysis, ABC achieves compliance through comprehensive documentation and regular internal reviews. Automated systems also enhance audit readiness and reduce the risk of disputes with tax authorities. So lastly, let's look at leveraging what we call it now, leveraging technology for risk management. Leveraging technology for risk management. Now, in this particular scenario, we'll be looking at DEF, a multinational technology company, leverages technology to manage transfer pricing risk effectively. Now, how did they implement this? DEF implements automated monitoring systems to track transfer pricing transactions and ensure accurate documentation. So the company uses data analytics to identify and address potential transfer pricing risk. DEF Limited proactively, or DEF Inc. proactively engages with tax authorities to discuss transfer pricing risk and issue, and also seek guidance on complex transactions. And the outcome of this is that DEF effectively mitigates risk through technology and data analytics. They also proactively engage with tax authorities to ensure compliance and reduces the likelihood of disputes. And with this, you can see that the outcome was positive because they were able to effectively mitigate risk through technology and data analytics, and to also They are also proactive, by being proactive in their engagement with tax authorities to ensure compliance and reduces the likelihood of disputes. So, in conclusion, now just to round this up, corporate governance plays an integral role in managing transfer pricing practices and ensuring transfer pricing and ensuring compliance with tax regulation. Corporate governance plays an integral role in managing transfer pricing practices and ensuring compliance with tax regulation. So, by implementing clear policies, strengthening oversight, enhancing documentation, fostering transparency, and leveraging technology, organizations can effectively manage transfer pricing risk and improve compliance. All the case studies that we have reviewed today illustrate practical approaches to implementing best practices in corporate governance. And transfer pricing, you can see that we've looked at different examples, which has also helped in which also help in enhancing stakeholders' confidence, reduce risk, and improved compliance. So all these case studies that we've used today is a practical approach to implementing the best practices in corporate governance and transfer pricing, which would result in enhanced stakeholders' confidence, reduce risk, and improve compliance. Thank you for your attention.